Hi, welcome to part 2, looking at pivot points and how the markets react around these levels. But before we can do that, let's load the pivot points onto the price chart. And just as a heads up, you will see that on this chart also we've got the test bars, we've got the moving averages shown as well, and I may also draw in some trend lines as well. And that's because with all of these advanced videos, we're just layering different techniques one on top of the other, and then when you have them all combined, you will see why the market does what it actually does. So that's why I've left all of these on, because obviously they're going to be relevant to the pivot points. But if you've not seen any of the videos on moving averages and the test bars, then go and have a look at those first, otherwise it may create a bit of confusion. But again, like I say, you will understand why all of this comes together and forms a very powerful predictor of market action. But the first thing we need to do is to add the pivot points to the chart. And we do that by coming over to Settings, Pivot Points, and then we're just going to put the check mark in Show Pivot Points and click Apply. Now watch all of these areas where the market has stopped and reversed or traded sideways when I left click on Apply. And all of a sudden you will see areas of support and resistance on this chart. So let's just have a look and see what's going on here. So you can see the market's sideways here, and we can see the market's also testing. Again, look at the videos on the price bars and you'll see exactly why the market's doing this, because we had some selling before straight through the DP level. Market trades sideways, and then we see new professional buying come in. It goes straight through the support, straight through the DP, and all the way up to the R1. Now, had you been a buyer of this market, you know that when we have traveled this sort of distance, there's going to be some sort of profit taking coming into the market. Just as if you were short off here where the previous day's high, the market went through the close and then moved lower. So if you were short and then you see the market being tested, you know that you want to consider either closing off most of the position, half the position, or the whole of the position there. So the market the next day moves higher. It's above the 20-bar average, and the market then puts in a sell signal that doesn't work. It's a black one. It's a losing trade. And the reason for that is that the market's going down to the previous day's close and finding support. So once again, we see the market being moved higher. The problem is nobody wants to participate in the trade. We're stuck in no man's land. And then we get another sell signal because the market's or the software is determined that there's nobody wanting to play ball here, and we see the market move lower. Now what's important here again is that breakout. We've got the breakout to the downside. We're also through the DP level, and we're through the close as well, and the two averages. So now the market is giving that bearish indication. And even though the market is tested here, there is no follow through back to the upside. The market then continues to the downside. So once again, we see the market go to the previous day's close. It then drives through this all the way down through the support 1 and the support 2 before finding support with a pogo stick. And then we see the market being brought back with some professional buying. This is a resistance area, the previous day's high, the previous day's low, and the market sent back down to the S2 before it bounces back to the S1 and then trades sideways overnight below the averages, below the DP levels. So once it's got back to the DP level on this day, let me just drag the chart over a bit. You can see there now we have a sell signal. Why is the sell signal so good? Well, it's below the close of the previous day. We've got some potential weakness here in the test bars, and also we've got the market failing to break out to the upside following the DP. So once it closes below the DP, we then see the market move all the way down through the low of the previous day, the S1, and then eventually to the low of the new day. And again, I can sit here and go through this until well, forever. I mean, there's no denying here what's actually going on. When you combine everything together, you can actually read the market very clearly indeed. You can see exactly what's going on, where it's likely to trade to, come back to, go to, come back to, go to, and then in concert with the DP, there you can see the market's now above, and you can see that we have a buy signal above the 2 averages and above the DP level. And there is some buying around as well, professional buying, because we've got the green bar. The market goes up to the R1. They fade the signal, bring it all the way back. But again, the market now back above the close of the previous day, back above the DP level. And then once we're above this, the market then drives all the way to the R1, pulls back with some profit taking before driving up to the R2 and the R3. And like I say, we could sit here for hours and hours just going through these charts, and you will see the same pattern all of the time. So again, we've got a situation here where if you look at it, you'd say, right, so the market is below the DP area. It was below the DP the previous day, and then the market breaks to the downside. We're also, more importantly, when you've seen the video on the averages, we're below the 20 bar average, below the 50 bar average, and also the 200 moving bar average as well, which is sort of the longer term, no matter what the time frame you're looking in. You've got the 20 bar average, which is the short term trend. The 50, the red one here is the short term trend. You've got the medium term trend in the blue, and then the longer term trend in the black, 200 bar average there. So once it's below all three, and then you're getting sell signals, you know the market's going to go in the direction you want it to. And also, this is important, you are below the DP, and we know from what we saw in the intro video, when you're below the DP area, it's likely to be bearish. So when you come to set up for the day, you can just look at this and determine exactly where we are. Now, this is a weekend when I'm recording this, which can be a bit patchy, but you will see yesterday on the Saturday, the market drove through. We got a fade trade because the market traded sideways after there was no follow through, not even to the previous day's high. And then the market came in on the overnight, early hours of Sunday morning, and sold the market all the way back down to yesterday's low. And now it's trading sideways. We're below the averages here. And in order to move higher, if I wanted to trade this, I know that I could get a short-term trade up to the DP level. Got to be very careful in this area here because the market could actually reverse and then head back. We get what's known as the fade trade, unless we get a really good breakout and a follow-through, which we didn't get here yesterday. Let me just remove this so you get the breakout there yesterday through the averages, through the DP level, but we had no follow-through. And here we got the hallmarks of the market looking like it's going to have another go at doing this. But you've got to be careful, because unless it does this and trades up to the R1 and then through it to the previous day's high is going to also be an issue, then you will see the same thing happen again. So I know when I come to look at the market first thing in the morning, I'm looking to see where the market is in relationship to the DP. It's currently below it. It's below the averages, and that's without using bigger time frames like the daily chart. Is that bearish? Is it trading below the averages? So if I just switch to the daily chart, I can get a good indication of what's going on here. And also it's broken below the trend lines, and I've got all these other indicators which we will cover in the advanced videos also on this chart, and I can see exactly where I would expect this market to go if the market failed at the DP level. Now, I know there's a lot of information in here, but don't forget I will be covering this in the daily market alert that I do anyway, and highlighting these areas and covering this in the alert first thing. So again, you will it's not just a one-off, it'll be an ongoing education of how to read the markets. Okay, that's going to do it for this one. I know there's an awful lot in here, but once you've watched the other videos, you will see exactly why the market does what it does in these areas. There's no mystery to it. And once again, it allows us as traders to be able to read what's going on. There's nothing random here at all. And as you watch the markets unfold in real time, you will see the market trading up to these levels and down to these levels and then finding support. And that's because, as I said in the original video, the floor traders needed some way of knowing where the markets were likely to find support and resistance. They didn't have charts, so they used the mathematical formulas that you saw in the first video in part 1, and then we're able to write those numbers down, and the markets traded to those areas. Now the floor traders don't exist anymore, which is really sad, but that's another story. And this of course is all done by computers, so really everybody can see now exactly why the market's trading to these levels. Okay, that's it for this one. If you do have any other questions, then please do let us know. But like I say, you'll probably find the answers to your questions after you've watched all of the videos on the advanced trading theories and practices. Okay, that's it. As ever, thanks for watching. See you in the next one.